Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Good morning, ladies and gentlemen. This is with our extended coverage of third quarter earnings as far as stock markets are concerned. And with us is a special guest. We are joined by Mr. Ajay Patil. He's the Vice President and CFO of Cummins India, a very well-known company in the engines, the gensets, and the lube space. Mr. Patil, a very warm welcome to you. And I was hoping that you will be smiling very broadly with the kind of earnings that Cummins has come up with. Fantastic numbers, a 26%, 29% rise in third quarter profit to 443 crores. Revenues have surged 16% to about 2541 crores. Any parameter that you see, EBITDA that's higher, sales on the regional side are doing fantastically well. Raw material costs have gone down. It's some kind of a Goldilocks scenario working out for Cummins, Mr. Patil. I'm sure your team and you in particular are very happy. How do the earnings look?
No, first of all, good morning to you, Shailendra, and to all the viewers. Very happy to be with you. Always a pleasure speaking with you. Thank you for all the compliments. We are happy we could deliver a strong quarter. We could deliver a strong year-to-date performance as well.
Yes.
Revenues are up 25% when you look at it from a year-on-year perspective also. So in all, I think turning out to be a good 9 months from a current fiscal point of view. I attribute this to few factors. What we have been consistently saying is that internally, the way we guided, we continue to focus on delivering a double-digit growth rate from our top line. And all of our businesses, when you look at our power gen business, our distribution, as well as the industrial business, I think looking at the economic tailwind, looking at the positivity and the demand outlook from the end markets that we serve, we are in a position to leverage our technology position. We are in a position to leverage our on-ground presence in country for last 60 plus years. And a strong brand that we represent meant that we continue to be preferred by our customers. And all of that translated in the results that are in front of us. And we continue to work towards delivering as strong a result as we can, given the current economic conditions.
Okay. Let me just put these results in perspective for our viewers. And I'd just like to start out with a phrase saying that who says elephants can't dance? This is a 4-digit stock. This is by no means cheap. Look at the stock price in front of you. At the moment in the vicinity of somewhere like 2,600 rupees. Yesterday, there was a blowout that happened in terms of price. The counter rose 7.7%. And what's really remarkable is what Mr. Patil says, that this is a consistent performance. The last second quarter earnings came on November 17th. The stock was at 1,700 rupees. And from then on, it has appreciated to the tune of 57%. Look at the performance in 2024. In the about 35 trading sessions that we've seen, Cummins India is up 33%. And that's come in mainly because of the strong expectations and, of course, the wonderful performance that Mr. Patil's team has delivered. Let's now look forward, Ajayji. What about guidance? Where do you see this fantastic performance leading to you in the fourth quarter? And then maybe some expectations for the next financial year, which investors can look ahead to.
Absolutely. I think as we kind of guided on our analyst call or earnings call yesterday, I think we continue to look at delivering a a double-digit growth rate for this year. The reason we are confident of that double-digit is driven by the fact that all the end markets that we serve, when you look at our power gen business, the principal end markets that we have, whether it is data center, commercial real estate, residential real estate, infrastructure, manufacturing, rental. Now, all of these end markets, we see the demand is holding up quite well. Each of these end market have different triggers in terms of how they are likely to grow in the coming years. Data center, as an example, we see this as a multi-year phenomena in terms of how there will be continued investment as the broader economy and the way we are digitizing our ecosystem means that end market will continue to grow. Couple that with the data privacy laws, which entail retaining data in country. So that bodes really well for that segment. Infra, I think the government is committed to, even in the interim budget, there was greater allocation for the capital expenditure from the central government, which would mean the continued investment into infra, again, is something which is positive for our industry. And then we look at some of the other sectors. Real estate has bounced back, and I think all of us see the trend in the commercial and residential. So in summary, I think the macroeconomic as well as the end markets are showing a promise of holding up of demand, at least from a domestic point of view.
Okay. Since everything looks to be on the positive side, Mr. Patil, let me just point to some parts of the business which haven't been up to the mark. The mining space, the railway space in particular. This is against the backdrop of a huge amount of public and private expenditure coming into mining, and of course, the public expenditure coming into railways. How come these two segments underperformed?
I think when you look at the segment that you talked about, railways and mining, is part of what we internally call as our industrial business, which is up 14% relative to year-on-year number. Internally also, we do believe that this could have done better.
Yes.
Frankly, with our industrial portfolio, we believed it should have done much better. Frankly, the construction segment for us has done well when you look at within those sub-segments, but it has still not met our internal expectations. We believe that this particular vertical from our business could have actually done much, much better. So we are hopeful that in the coming year, this particular vertical of industrial, which comprises construction, compressor, railways, mining, defense, oil and gas, marine, it's a broad segments that we are talking about. We expect to do well. We are hoping that they do well, and we are well positioned both with our product and technology to service the demand in that particular vertical.
Okay. Mr. Patil, let's touch upon the EBITDA margin. Of course, a wonderful 250 basis point uptick at current levels. This was aided by lower raw material costs. Are these manageable and predictable over the next 2 or 3 quarters at least, or this was a one-off?
No, I think it's a combination which played out over the previous quarters. I mean, as we have seen the commodity prices start to soften, while the pricing actions that we had taken when the commodity costs were rising, the lag effect of that pricing is playing up and the softening of commodities. So it's actually a trend which is going favorable both on the pricing as well as on the cost side. Now, obviously, the way the commodities are softened over the last 12 to 18 months, to what degree they would continue to soften is difficult to say that we'll have the same level of commodity tailwind that we got in the 9 months. But on the other hand, what we are continuing to do is that internally, we have always looked at our pricing in a manner to see that we continue to win and always had that kind of a pricing power in our favor. Number two is that on the cost side, while the broader commodities have given us the tailwinds for sure, but we also have a very disciplined program in terms of how we manage our cost, especially when it comes to material cost. And we do believe that we have a robust process in place to continue to find ways to drive that productivity. Now, whether it will translate into this 300 plus basis points that we see year to date, I think time will tell, because there are still some, headwinds that we see with respect to disrupted supply chain, the geopolitical
Absolutely.
tensions, still in a very limited manner, some amount of electronic supply chain, which is still not fully normalized.
Okay. This was my next point, Mr. Patil. You've had a fantastic number thanks to soaring domestic sales, but exports have been a bit of a bummer. They are down about 40% year on year. And, your main export themes, Middle East is in a bit of a problem. Europe is facing issues. And of course, the US is also not doing pretty well. So, in the coming quarters, do you see an uptick happening on exports that, of course, will add a deep luster to the performance on the total basis on total revenue? But any view on exports? Why did they fall so dramatically? And how does the thing look from now on?
Yeah, I think over the last 2 or 3 quarters, we have been kind of indicating the softening of demand on the export side. It's not that it has happened only in this quarter. I think over the last 2 or 3 quarters, if you look at our commentary, we have been indicating that the export markets are softening. For this particular quarter, I think it's a combination of a few things. One is, of course, importantly, the end markets in those geographies, whether it is Middle East, Africa, Europe, Latin America. These are our principal markets, Asia Pacific. We have seen across all the market there was a softening. It is through a combination of, I would say, some kind of a inventory management or destocking that would have happened. Second thing could be a function of some amount of intensity when it comes to the competition in terms of how the pricing has played in that particular market. Our hypothesis, which we have guided on the earnings call, was that we do believe that a portion of our exports market is now bottomed out. And therefore, we do expect some kind of a gradual recovery over the coming quarters on the export side. And we say that on few grounds. We say that on few grounds because we do see a core demand in that particular economy still intact, whether it is on the Middle East side, on the Africa side, Latin America, or Europe side. Number two, we look at our positioning and the channel through which we sell in those markets. I think when we look at these two things together, and third, of course, is a brand and the product positioning that we have, where we created a strategy of what we call fit for market. These three factors, we believe that if there is a bit of a demand revival, we will win our fair share or more of the market in those respective geographies.
So domestic sales are absolutely in top form. Exports are likely to sort of improve from where they are now. Margins you hope to be better, if not at the same level currently. And there are little or no cost pressures. Mr. Patil, truly a Goldilocks kind of a scenario for Cummins India, isn't it?
No, thank you for the compliments. But I mean, our endeavor, of course, is, as we keep repeating ourselves, is to see that we continue to believe that we need to grow, and there are enough opportunities for us to grow. I think purely from a on-ground presence point of view, we think we are here for 60 plus years. The kind of manufacturing setup that we have, the kind of engineering capabilities that we have, positions us really well to be a preferred choice for our customers.
Mr. Patil, why is capacity utilization only at about 65-70% levels? When you're posting record sales, when you're posting record profits, how come capex utilization is being capped at about 70%? Is that something to be worried about, that corporate India, which is your customer, isn't utilizing the factories that Cummins has set up? Or is this capacity that you've planned in advance?
I think a combination of factors here. One is we always believed in creating enough capacities so that whenever the demand rebounds or the demand revives, we are in a best position to serve it. So that's exactly where our capacity utilizations are. But on the manned capacity side, just to clarify, we are in excess of 90%. So what it positions us really well is that should the domestic or the export market continues to grow, even at an accelerated pace, our ability to service that demand is ready on the ground. So we are
Okay.
not really required to invest or put in additional capacities because we already have that in place to service the demand.
Yeah. So that spare room that's available for Cummins India, I would have imagined that given the record profit, record sales, and record profitability, your factories would have been working at about 100, 205% capacity. But I understand it's 90% on utilization level at the customer end, and 30% is spare, which is fair enough given the
Yeah.
demand that's coming in. Uh, the pain point is uh, the global supply chain, Mr. Patil, issues around the Red Sea, issues with China are sort of maybe giving you sleepless nights. Have lead times sort of increased when it comes to spare part availability, as also your products reaching export markets? Has that happened?
Yeah, I think clearly with the crisis and the disruption in the supply chain because of the Red Sea route is no doubt impacting the lead times. So at this point of time, it is more about a lead time and a cost issue because the freight rates have gone up, the lead times have gone up. But from an availability perspective, I think we continue to secure the kind of imported components or parts that we require because we function globally as an integrated supply chain. So therefore, availability is there. It is only the freighting routes which are causing delays to the extent of about 2 to 4 weeks in some cases. But that's impacting a relatively small portion of the supply chain for us and very specific to few electronic components.
Okay, let's pay attention to the pollution control norms which are specified by the CPCB. So the new gensets that are coming out from your factories, of course, follow those norms. What is the positioning now? Till when? This is, I think, the deadline is June 2024. What is the update on that one? And are you enjoying higher margins on these new gensets that you are selling because these norms are now being implemented?
No, absolutely. I think the CPCB 4 Plus, as those emission standards are called, they were made effective July 1st of 2023. However, there was a certain clarification which was provided, allowing both the previous emission standards of CPCB 2 plus this 4 plus continued to be made available to customers up until June of 2024. What we saw as a consequence was that a quarter prior, there was a pre-buy and at the last minute, this clarification came. What we see is that because the various state governments have their own respective norms on emissions, so we do see a continued demand for the new products, which is CPCB 4 Plus. Thus far, close to 3,000 or more of our gensets have been sold under that category. Number two, you asked about pricing. These are two different technologies. So therefore, the pricing is not comparable. We are talking about a transition from mechanical engines to electronic engines, which are going to provide that sort of a precision fuel delivery to ensure that the emission standards are complied with. And with our overall experience on the engine technologies that we have at a global level, a combination of engine and after treatment systems that we provide, we believe that we have possibly the most robust solution that we can offer. And we see that in terms of how customers are preferring us. Although because of the technology difference, there is a price difference between the previous and the new one. But I think we are hoping that by June 24, the previous emission standard kind of sunsets, and then we fully transition to the new emission standards from July 1st, 2024 onwards.
Okay. Mr. Patil, if we listen to your commentary, and of course, I've been speaking to a couple of analysts, they're more than happy with the kind of effort the management has come in as far as delivering this fantastic performance is concerned. Guidance you've given 2x the GDP growth, as also improvement in EBITDA and strength coming in on pricing as well. Is there anything at all that keeps you worried, keeps you awake, given the broader framework in which Cummins India operates? What are the pain points?
Not really pain points. What we continue to believe is that we can really do more. Our aspirations are much higher than what our results demonstrate, and those aspirations are coming from the fact of what is possible. The possibilities are infinite in terms of how Indian broader economy can grow, and along with how we can participate in that growth. So that gives us a lot of energy. That gives us a lot of strength to say that we can do more. So more than the sleepless nights, it's about getting that dose of energy to say that can we do more and play our part in building the uh, Indian economy and building the nation, so to say, because our products go in practically every aspect of the economy. You could look at any infrastructure today, and we would have played our part there. So we do believe that it's not only about a commercial work that we provide as a business to run, but we also somewhere contribute in building the Indian economy and along with the Indian nation.
Absolutely. I have no doubts in my mind when you talk about nation building. Cummins is a product that's known for at least half a century in India, both for the quality of the product as also the robustness. Mr. Patil, my final question to you is in the point that you raised was data centers. You said that growth is phenomenal in that area. I believe it's up about 50% over the same quarter last year, the business from data centers. What are the kind of customers that you have, if you could name a few? And geographically, where is this demand coming from uh, as far as India is concerned? Which is the maximum geographic area which is showing strong growth and the maximum geography contributing the highest?
Yeah, I think the data center growth that we see is driven by the need for how we support the broader digitization that is on an accelerated path in India. You look at today what's happening with our banking and financial services. They're pretty much all electronically delivered today. You look at all the e-commerce growth that we have seen. We have seen how the supply chain is getting digitized. All of this is requiring a significant infrastructure from the data center side. What we have seen from a geography point of view, I think Navi Mumbai, Chennai, Hyderabad, to some extent in the north, Noida, these are really the centers which are coming up where larger data center capacities are coming up in country to support the various needs. These are all what we can call captive to small to hyperscale data centers.
Okay. Mr. Patil, as always, it's a pleasure talking to you and understanding what is humming inside Cummins India. All the very best to you for the fourth quarter, as also for the two next years where you've pointed out strong guidance. And good luck to your team.
Thank you so much. Always a pleasure speaking to you and your audience. Thank you so much.
Thank you. So that, ladies and gentlemen, was the CFO, Mr. Ajay Patil of Cummins India. A very strong quarter and an equally strong bullish guidance coming in from this company. The stock already is at a record high and is doing phenomenally well in the markets. Stay tuned as far as the update on news is concerned on financial markets. For the moment, thank you from my side and from our PCI team.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
Celebrate 32 years of leadership in business news with Business Today. From the groundbreaking AI cover of Sundar Pichai to PM Modi's exclusive on G20, we redefine headlines. Now our 32nd anniversary issue explores India 2029, the 5-year agenda with industry titans sharing exclusive insights. So, just BT it for unparalleled perspectives. Business Today. 32 years of leadership, innovation, and business brilliance. Subscribe now. In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations